Welcome to the Personal Money Management Series 2, where we'll talk on how to break down a monthly budget. Remember to like, share and subscribe to this educational resource and stay glued till the end. Now let's break down a monthly budget. The best way to do this starts with creating a spreadsheet. First, identify your financial resources. Start by calculating your monthly income. Income is money that an individual or business receives in exchange for providing labor, producing a good or service, or investing money. Individuals most often earn income through wages or salary. Businesses earn income from selling goods or services above their cost of production. Whether your income fluctuates, is steady, or a combination of both, you should be able to calculate a monthly average based on your past earnings. Then list any investment income, alimony, child support gifts, or other income you have. Next, consider what's important to you and prioritize expenses. When listing your expenses, divide them into 3 categories: fixed expenses, variable expenses, and discretionary expenses. Fixed expenses are those necessary and unavoidable expenses in which the amount you pay monthly does not vary. These include your mortgage payment or rent, property taxes, alimony, and child support, and a car payment. Include any other fixed expense like insurance premiums or other loans or debt payments. Remember, these are the expenses for which you pay the same amount every month. Variable expenses are also necessary and unavoidable expenses, but the amount you have to pay can vary from month to month. These are a bit trickier than fixed expenses to budget for because the amounts change. Examples of variable expenses include utilities, groceries, public transportation, medicine, credit card payments, gasoline, clothing, and your cell phone bill, depending on your usage. However, develop the best estimate for your budget, looking at what you've normally spent in the past. Finally, add your discretionary expenses. These are the avoidable expenses, the luxuries, or nice-to-haves. They might include items such as entertainment like movies or concerts, eating out, games and recreation, gifts, and vacations. These are expenses that are not necessary for you to achieve your financial goals. Depending on those goals, you'll want to keep your discretionary expenses as low as possible on a monthly basis. Use them more as rewards for hitting some of your financial goals. Now use your budget to compare income versus expenses, to see whether your monthly income covered your monthly expenses. It's time to do the math. If your income exceeds your expenses, you have a budget surplus. This is good. That means you have discretionary income or surplus income. If you have a surplus, it can be used to increase your savings and investments. If your expenses exceed your income, then you have a budget deficit. This means that you don't have enough income or resources to cover your planned expenses. The first place to look to address this deficit is in the discretionary spending section of your budget. Trust you enjoyed the ride. Do well to subscribe, like, comment and share this content. Equally support this project by reaching out via email, personaldev.motivation@gmail.com, telephone and WhatsApp, +23768 139 2760.